Let's do it, folks. A busy one today. Welcome to TheStreet Today here from Post 35 on the floor of the New York Stock Exchange. It is Monday, the 13th of March, though it might feel like Friday the 13th to some. I'm your host, JD Durker. About an hour or so into the trading session today, markets are trading more or less in the red as investors continue to react to regulators' plan to backstop all depositors in the Silicon Valley bank collapse. We got that announcement last night from the FDIC, from the Fed, as well as from the Treasury Department. We'll have all that and so much more on the show today. Speaking of the show, we will also talk SVB's collapse as it continues to rattle global markets. Plus, we'll tell you how this crisis might impact the Fed's next move. And finally, we'll talk inflation bets as tomorrow's highly anticipated CPI report inches nearer. It's easy on a Monday morning to forget that there's all these other data points like CPI and all these others that we follow, but we are following those. For more on those stories and so much more, we now bring in Mr. Martin Baccardax. Martin is our senior editor and our chief markets correspondent, and the only man who can help bring sanity to an otherwise insane world. Let's start with the president, shall we? Earlier today, President Biden addressing the nation. This is an attempt to reassure Americans amid this collapse. Let's take a listen.
First, all customers who had deposits in these banks can rest assured, rest assured they'll be protected and they'll have access to their money as of today. No losses will be borne by the taxpayers. Let me repeat that. No losses will be borne by the taxpayers. Instead, the money will come from the fees that banks pay into the Deposit Insurance Fund. Second, the management of these banks will be fired. If the bank is taken over by FDIC, the people running the bank should not work there anymore. Third, investors in the banks will not be protected. They knowingly took a risk, and when the risk didn't pay off, investors lose their money. That's how capitalism works. And fourth, there are important questions of how these banks got into the circumstance in the first place. We must get the full accounting of what happened and why those responsible can be held accountable.
Martin, what are we to make of the president's reassurance? He didn't say a whole lot other than what we got last night at that statement at 6:15, but the White House clearly feels it's important to have the president first thing on a Monday before markets open speak to the American people.
Yeah, I think there's a lot to parse through with the president's statement. I think going in reverse, I think the idea of trying to find out what happened is probably a noble sort of cause, but it's going to be exceedingly difficult. And by the time that Congress gets to the end of it, it's very likely to be in a new session anyway. So I don't expect any regulation to follow through from this. On the third point that he makes with respect to whether or not whether or not investors should be protected by the taxpayer, I think he's absolutely correct. And I'm glad to see that the rescue effort does not include equity investors or indeed bondholders. I think that would certainly create a moral hazard in this situation, and one that the taxpayer just isn't likely to sort of support, particularly when you look at it through the prism of the 2008 financial crisis. What he said about taxpayer funding remains to be seen. I don't think there's any fully guarantee promise just yet that the taxpayer isn't going to be involved, simply because the rescue is only focused on 2 institutions right now, and that number could accelerate in the coming days. And by that time, fees paid into the FDIC may simply not be able to bear the weight of depositor guarantees. So the president may rue that statement going forward. Time will tell. One thing he did say, though, JD, that I think deserves a bit of scrutiny is the idea that bank management is going to be fired immediately after an FDIC takeover. While that may sound good as a political soundbite, what the president and others have to remember is that any senior executive in a bank that is facing balance sheet difficulty is going to be reluctant to admit so, because he or she would find their job at risk as a result of being rescued. That really only creates or engenders the risk-taking that led to the situation we saw at SVB in the first place. So I don't think that's a particularly sound policy, and it's one that actually could create more trouble than it's worth.
The president did not take questions, not that I expected him to, but if he did, and you were in the room, what would you want to ask the president? Or, knowing you, I feel like your question might be geared more towards Secretary Yellen, maybe even Chair Powell, anyone with regards to the FDIC, to last night's statement as opposed to the president. But what would you ask anyone who oversees these institutions?
No, I'm not exactly sure. I think maybe the first question would be simply how did these regional banks come to escape scrutiny with respect to the backstops that are in place for larger financial institutions? And if that systemic risk was out there, why didn't the previous Congress address it? There's no point now in pointing at the Republicans and saying that they were instrumental in rolling back regulations because Democrats had control of the House over the last session and could have reversed the reversal. So ultimately, you want to know exactly how it came to be that these smaller lenders, which we know are integral to various sectors of the economy, particularly the tech sector, how did they find themselves outside of the broader scrutiny, which, it has to be said, has been very successful in mitigating risks in the largest U.S. Financial firms.
Let's take a look at that statement that was released last night by the Fed, the FDIC, and the Treasury. They say today we are taking decisive actions to protect the U.S. economy by strengthening public confidence in our banking system. The statement goes on to say that Secretary Janet Yellen approved actions enabling the FDIC to complete the resolution of Silicon Valley Bank in Santa Clara in a manner that fully protects all depositors. Depositors will have access to all their money beginning today, the 13th of March. Is it enough here, you think, to actually limit the fallout from the collapse? For all the concerns about contagion up until Sunday evening, all the questions about what would happen, did they do enough, as you see it?
I thought last night on face that it was an elegant solution. I think the idea of protecting depositors, even though many of them are small to medium-sized companies with balances on the books at SVB of more than 250,000 US dollars, one could argue that companies need to have their own risk management in deciding what institution to bank with and maybe shouldn't be bailed out as a result of this rescue. Maybe that's a discussion for another day. I think in this circumstance, protecting the depositors whilst allowing equity and bondholders to be wiped out was the right thing. Actually, JD, I think the more powerful tool in all of this was the Fed backstop that was unveiled after the Treasury statement. And essentially what that did was put up a new lending window for banks all across the country to access. They can take Treasury agency and mortgage-backed securities to that window and borrow them without any discount to their market value for cash that would last for about a year or up to 1 year. So essentially what those things should have done, both the Treasury statement, the protecting of depositors, and the Fed backstop, what it should have done was reassure those with deposits at other institutions that they are going to be made whole in the case of any difficulty, and further offer a backstop support that wouldn't allow the balance sheet deterioration to accelerate in the way that it did with SVB. So I'm a little bit surprised that we're seeing some other regional banks come under such stress this morning because they can access that window. It is unlimited and it should be enough, I should imagine, to at least cover the deposit base. Whether that means that the business operation is eroded is another story, but it shouldn't be eroded to the degree that we're seeing in share prices for banks such as the First Republic and others.
That's a great point to the regional names. I wonder what you make of some of the bigger names, at least what we're seeing for the stock movement. Bank of America down 3.4, Wells Fargo down 5 and change, Citigroup down 5.7. Is that the expectation you had for some of those names heading into this Monday morning session?
No, but I think it's a maelstrom of things, JD. I think ultimately it is concern about to what degree the bank run spillover will have on the larger institutions, because they, of course, have exposure to some of the banks that might see depositors flee. I think also bank stocks are going to be under pressure anytime you see such a sharp pullback in Treasury bond yields and a big change in Fed rate projections. So that's being factored into bank stocks as well. And simply, you just have a lot of market volatility this morning. The VIX, the CBOE Group's benchmark volatility gauge traded over 30 points this morning. That's a massive surge from the low 19 points that we saw this time last week, and does indicate that markets are all over the place today and very likely to be so for the coming days until we can understand where the floor is in this story. So I'm not terribly surprised that the stocks are pulling back to this degree, because I think there's just so many factors that are being blended into the share price that we see today.
Bill Ackman, hedge fund manager, said he doesn't, this at least a few days ago, he said he doesn't see another bank coming in to buy SVP, much like we saw with JP Morgan previously with names like Bear Stearns. We go back to '08, of course, Washington Mutual. Is that a fair read, knowing that the company, that the bank had those challenges on Friday morning to find a buyer, and now it's going to be incumbent on the FDIC to largely try and get someone? It's just not immediately clear who, I suppose.
Yeah, I mean, it's an easier call to make today because nobody has stepped up and they've had ample opportunity to do so. So I guess I would be terribly surprised if the operations were picked up. HSBC bought the UK business of SVB this morning, but that was a purchase that was orchestrated by the Bank of England, and the assets were only pegged at the value of £1. So ultimately, the deposits and the loan book were taken over by HSBC essentially for free. I guess you could argue that a similar orchestration can happen here in the United States. But at this stage, I don't know who wants to take on a tech VC loan book in the current condition that we're seeing in the tech sector. We're seeing layoffs all across the board, even at the biggest companies. And if there's going to be a choking off of funding for the smaller startups and the other VCs that are associated with the tech sector, then their value is only going to deteriorate. So who wants to step in and buy that loan book, whilst at the same time taking risk that the deposit base is going to flee simply as a result of contagion concerns, whether or not they're valid. So I think it is going to be exceedingly difficult to find a buyer for the SVB financial assets. It could still come to fruition. Maybe somebody like JP Morgan could take one for the team, I guess, if you will. But the fact that it hasn't materialized as of Monday morning, I think is very concerning.
So, I mean, aside from the obvious, which is that the client base of SVB are technology companies, and there's likely a withdrawal or a pullback on deposits into the bank, I get that. Part of the challenge, it seems to me, with Silicon Valley Bank has been its existing bond portfolio. These are bonds that were purchased at previously issued lower rates. Those inherently become devalued in a high interest rate environment because you need to sell them at a loss, previously issued bonds, to try and compete with newly issued bonds, which we know are yielding much handsomer returns, if you could say that about something that's typically as not exciting as the bond market. But to me, that's not relative to SVB. Is that not this more or less the same problem that a lot of regional banks, that a lot of big banks even, are going to find themselves in when you go back to this era of buying all these treasuries and mortgage-backed securities in 2020 and 2021? Are we not talking enough about that part and how it could be impacting other banks? Or I wonder what I'm missing here, Martin.
No, I think your figure is right on the post, JD. It absolutely is an issue for banks that have hoarded a lot of treasuries, a lot of agencies, and a lot of mortgage-backed securities. Obviously, with SVB, the concern was intensified because they were purchasing securities of a much longer duration. And of course, as a result of the increase in treasury bond yields, the value of that portfolio, as you rightly articulated, fell precipitously. And ultimately, SVB had to take a loss of about 1.8 billion. They tried to do a capital raise to plug the hole, but the people that they were looking for to plug that capital hole were just watching deposits flee, and they said, we're not getting involved in that. But your larger point is absolutely correct. There's an estimation that the increase, there's been about a 5 percentage point increase in the amount of mortgage, agency, and treasury bonds that are sitting on bank balance sheets all around the country. And the St. Louis Fed warned us only about a month ago that in a rising interest rate environment, there were going to be unrealized losses on that paper, and that could be a concern. But JD, that's where the Fed backstop comes into play, and very importantly so. If you are a regional bank and you're sitting on a loss-making bond portfolio, you can take those treasuries, those agencies, and those mortgage bonds to the Fed window. Let's say they're trading at 94 cents on the dollar. The Fed's going to give you par value in terms of a one-year loan. So you can hand that loss effectively over to the Fed, get it off your book, get an actual loan that you can then, at least in the Fed's hope, move into the real economy and keep engendering credit activity, which is, of course, the central plank in economic growth anywhere in the world. So we are hopeful that that Fed backstop will allow those banks which are sitting on unrealized losses to at least neutralize them for the moment. And then once the interest rate position or picture from the Fed perspective gets really the reason why I think the Fed backstop what the Treasury did with SVB.
But does that backstop apply only to regional banks?
No, it applies to institutions. It applies to institutions all over the country. And actually, JD, that might be part of the reason why we're seeing such a rally in Treasury bonds today, because any Treasury bond that is trading at a discount to par is going to be worth purchasing, because you can buy it and then flip it to the Fed and get a one-year loan. And you, on that one-year loan, can very likely engender a return that's higher than the Treasury bond that you handed over to the Fed in the first place. That wouldn't work for bonds that are trading at a premium to par value, because you'd have to take a loss on that. But nonetheless, those that are trading on a discount have become very popular. And I'm certain that's a big part of the reason why, alongside risk aversion, that you're seeing this big rally in Treasury bond prices and the corresponding decline in yields.
Yeah, we are seeing that decline in yields, the 4-year. I mean, what a conversation we were having on Wednesday and Thursday of last week at the 4-year above
So
5% for the first time since '07. We talked about that split between the 2s and the 10s. And now we're looking over at the U.S., the 2-year note is now just barely above 4%, 4.03 if you were to round up generously. So that's an interesting move. You and I, or you specifically, you follow the dollar index very closely. I'd like to ask you about it. We're talking the strength of the dollar relative to a basket of some comparable foreign names like the euro, the yen, the Swedish krona, et cetera. Yeah. Help us better understand why we would have seen a decline in the dollar index the last few days as all of this has been transpired.
Yes, I mean, I think the best way to think of the dollar index, JD, and you described it well, is that it benchmarks the greenback against a basket of 6 global currencies, the biggest US trading partners. So in the pithiest form, the dollar index is the price of money. And if we are seeing interest rates decline so quickly, the price of money should correspondingly fall along with it. So we're seeing the dollar index actually down. I think the last I saw was about 0.6%. It's been trading at multi-month highs, so that decline could have been a little bit more. And I think the reason why the dollar is actually holding up relatively firmly is because foreign investors aren't quite believing what they're seeing in the Treasury market. I mean, you mentioned the 2-year note, JD. We are looking at the biggest 3-day decline for 2-year Treasury notes since 1987. And it's worth mentioning that on that day in 1987 happened to be Black Monday. So this is the kind of volatility that we are experiencing in markets right now. After Chairman Powell's first day of testimony to the Senate Banking Committee last week, I saw 2-year notes trade at 5.11% overnight in Japan hours. So to see them trading now at about 4.03% is an absolutely breathtaking move. And again, the kind of thing that I really haven't witnessed in 2 or 3 decades of doing this. So it is quite outstanding. And you can understand why foreign investors might not want to track the dollar down that far until they see the dust settle. But where the dust settles in the Treasury market is an open question, because we have to understand to what degree banks are going to use that Fed backstop, to what degree the Fed is prepared to take losses on the bonds that it brings in from that backstop and continues to raise rates, because that's exactly what's going to happen. And then probably most importantly, JD, and I would imagine this is your next question, what does it mean for Fed rate hikes going forward?
That is an upcoming question. I got a couple others before we get there. We will talk rate hikes because it was fascinating to watch. Also, another tale of 2 sides of the coin. Wednesday, Thursday looked like we were heading one direction with regards to rate hikes. Now we're on maybe a bit of a different page. But first, I do want to ask you about USD coin and how closely you follow crypto's second largest stablecoin. We did see it rally after the Fed and others had that Sunday evening intervention. Give me your sense on the impact there, weighing on crypto, and what should we know there about the stablecoin movement?
Everything you need to know about these ridiculous securities, JD, was demonstrated by the fact that they gained value once the dollar was deemed to be a better bet. All of these people are trying to sell you these digital assets on the presumption that they are a replacement for the dollar. And they all get buttressed in value when the dollar is buttressed in value on global financial markets. That tells you everything you need to know. They're absolutely worthless, and the only worth they have is if they are backed by US dollars. So that's really all I have to say about these. I'm growing increasingly irritated by the noise that's around the digital and cryptocurrency market industry, simply because they haven't really accepted the reality of the falling house of cards that is that whole Byzantine operation. FTX gratefully allowed us to lift under the hood, or to look under the hood a little bit. And everything that we have seen since then points to its fragility. And for it to have been supported by the dollar's strength in overnight trading tells you everything you need to know.
Sure. Well, I hope you don't mind the question, just for context,
Not
because
at all.
people are seeing the headlines, but I certainly understand where your perspective is. You know, we have these conversations several days a week. These aren't the sorts of that we don't talk about that lane, but it is one of the many data points to follow in light of everything else that has happened the last 72 hours. So I do appreciate that for sure.
Yeah.
It's also been an interesting reaction because there was a lot written about how the impact here with banking stateside was impacting Asian and European markets into our opening this morning. This was something interesting to track very late last night, and I was up later than I should have been. What was that reaction, Martin? And what sort of guidance or reassurances did we see from other major banks, or other markets, I should say, to their own investors to say what's happening in the U.S. more or less is safe, that's what's happening there, and we're not seeing the impact?
Well, I think that was the immediate series of statements that we saw from governments around the world, and you can understand why. It was essentially, listen, our banking system is solid. We are putting up firewalls to prevent any contagion from what is, at this point, an isolated bank failure focused on the tech sector in the United States. Now, after the Treasury came in with its deposit guarantee, and after the Fed followed up with the lending backstop, you saw equity futures leap notably in the after-hour session. That gave a decent head start to Asia stocks. I was surprised to see the Nikkei decline on the day, however, and I'm not entirely sure why that was, but I did see the broadest measure of regional shares in Asia edge modestly higher over the session, simply as a result of the relief that the Treasury had come in and the Fed had come in to such a significant degree. In Europe, it was a little bit more muddled. I think there was still concern that the purchase or the over-reliance on Treasury and longer-term dated fixed income products on bank balance sheets could become an issue for regional and benchmark lenders around the region. We've seen that happen already in the United Kingdom. We can recall back in September, JD, when you and I were talking about the implications for rate hikes from the Bank of England and what impact they would have on the pension sector. So I think there was some concern there. But again, the fact that SVB was sold very quickly to HSBC in the United Kingdom mitigated a little bit of that. And then everybody simply just wanted to wait and see how the US was going to open. But again, what we're seeing in terms of volatility won't let us get the clearest picture of what's happening for a good number of days. And until we find a floor with respect to this deposit flight situation, that's going to remain the case.
Okay, so let's talk about Fed at greater length. I've seen some people lay blame at the Fed, not necessarily for raising rates, but not doing it sooner, keeping rates near zero for as long as they did before. And then obviously, as you and I talked about at the end of last week, there is a direct impact both on Silicon Valley Bank as well as its customers in the tech sector that are feeling the squeeze of high interest rates. So for anyone that's looking at this from the outside perspective and saying, well, clearly here the Fed has done something wrong, either by not acting sooner or by acting too aggressively in this modern era of monetary policy, what do you say to those critics that say the Fed clearly has some responsibility with how we got here?
I think the first thing I would say, and let's take the idea that the Fed did not attempt to fight inflation as aggressively as it did. Where do people think Treasury bond yields would have traded otherwise? In other words, if we had allowed headline inflation to soar past 9%, which it did last year, would we imagine that Treasury bond yields would be higher or lower than they were? I mean, the answer, of course, obviously, is notably, significantly, much, much higher than they traded, simply because inflation is the enemy of bonds. If investors thought that the Fed wasn't doing anything about inflation, they would mark those bonds further down, rates would rise, and SVB would have been in financial difficulty several months ago, not just a few days ago. So I think that criticism falls on deaf ears. Where people do have a little bit of an element of support for the Fed criticism is that perhaps it could have decided to move earlier, and perhaps, probably more pointedly, could have moved faster with rolling off the balance sheet that it accumulated during the financial crisis and during the pandemic. This time last year, it has to be remembered, we were very close to 0% Fed interest rates, and the Fed was still buying Treasury bonds. And of course, that only allows banks to follow along in the Fed's wake and do exactly the same. So I think the criticism that the Fed could have moved earlier has some validity, although it does have the feel of Monday morning quarterback. The criticism that the Fed raised rates too quickly, and that's the reason that SVB failed, is perfectly ridiculous.
Are people now betting on the perceptions that the SVB story means an earlier and lower end to Fed rate hikes? And this can go hand in hand with our obligatory CME Group's projections question. What are we looking at now today?
Had you asked me that question 45 minutes ago, JD, I would have said, yes, absolutely. In fact, people are betting on a Fed rate cut, but it's changed dramatically over the last 45 minutes to the hour. And again, this sort of just illustrates the kind of market volatility we're seeing. But there's no question that the ultimate projection of the Fed funds rate has been lowered significantly as a result of this stress. And the Fed typically does pause, or at least sometimes it cuts and sometimes it pauses as a result of these significant financial events. And SVB is the biggest US bank failure since 2008, so it can't be sniffed at. But I don't exactly know where the path is going to play out, and maybe none of us will until we see the inflation figures tomorrow. If we get a softer than expected reading, the Fed might get some cover for at least a brief pause in its policy path whilst the dust settles with the SVB situation and the deposit flight that we're seeing in other regional banks. If it's a hot reading, they might not have any choice. So I think to some degree the market is coiled spring for that reading tomorrow. That said, at present, JD, people are definitely betting on a lower terminal Fed funds rate and very small rate hikes between now and the summertime. And that's a very different projection than we saw in the latter part of last week. And indeed, really right up until Thursday afternoon.
You know, it's amazing. I was up late last night till about 1 a.m. or so. I was working on some questions, and already some of the questions I wrote they're old, they're archaic at this point, just a handful of hours later. Because CME Group's projection for 50 basis points was as low as 10% last night. It's now up to 64%, to your point. Goldman had said it no longer expects the Fed to hike this month at all. So what are we to make of different points of guidance? And for all I know, in the few minutes we've been on air here, Goldman may have said, oh, oops, never mind, we're going with something else. But it really seems as if everyone has very quickly tried to see where the puck is going. And the puck is moving very fast right now, Martin.
Yes, I think to some degree, JD, what you think about where the Fed is going to go with rates probably reflects the criticism as to whether or not you felt they moved too quickly or whether you felt they didn't move early enough. I think certainly some of that is going to take your projections. But at present, I think it's just impossible to say because we don't know to what degree SVB is going to reverberate. Now, definitely we are seeing notable declines in regional bank stocks as a result of concern that deposits are going to flee. But I don't expect that to last too long simply because that Fed backstop is now in place. And it really should be enough, more than enough, really, to placate concerns about deposit flight because these banks can take these very high quality assets, turn them over to the Fed, and get one-year loans in return. But again, we have to see where the dust settles. What will become more important, however, is whether or not the inflation reading that we get tomorrow for the month of February is hotter than anticipated or cooler than so. If it does tend to pull back from projections, JD, you could suggest that the pullback that we're very likely to see in tech sector activity is going to spill over to the real economy. That slows growth and by definition eases inflationary pressures. If we can see that in the window, and have it buttressed tomorrow by a slower than expected headline and core CPI reading for the month of February, then you could make the argument that the Fed could hit pause or at least go on a much slower pace in terms of its rate hikes. But if that number is hot tomorrow, all bets are off.
Okay, I'm running out of time because it's already 11, but I do really want to get this last question in specifically about this. Is it
I'll be
fair,
quick.
Martin, to be more concerned now about unforeseen consequences of higher interest rates?
Yes, I think that is absolutely the case, and that is going to be on the mind of Fed policymakers without question.
All right, okay, I appreciate that. Thank you, because that's really been the question, I think, to me, as I'm looking at this story from the outside. We talked about at the end of last week the direct role of higher interest rates. Don't know how many people saw this coming, and for the voices of criticism that are now saying, well, what else is now going to happen now that interest rates are higher? And strangely, to me, it's the kind of strange bedfellows story where maybe you have, like, to our congressional testimony conversation last week, the Elizabeth Warrens of the world, and maybe some, staunch conservatives might actually agree right now with regards to something like that, but I don't know. It's going to be a fascinating story to follow. Okay, CPI set for tomorrow. What are we anticipating, and how important as one of the final data points for the FOMC to take into consideration the 21st and 22nd?
Yeah, now it's going to be absolutely crucial, JD, because again, if we get a hotter than expected reading for either the core or the headline, we are going to upset the apple cart with respect to what the markets are anticipating from the Fed. The Fed is essentially going to find itself in a bit of a rock and a hard place. If they carry on with their policy path, absent of any concerns with respect to SVB or the regional banks, essentially what they are telling the markets is that that risk is contained. Now, if they pause or indicate that they're going to slow the pace of rate hikes, what they are essentially saying is that they're giving up on the inflation fight and they're worried about the spread of contagion from SVB and the other regional banks. So you can see how difficult it is for the Fed to pivot under these circumstances. So I think to some degree, the Fed is probably very happy that they have a 1 week lag between the Tuesday CPI reading and their policy meeting in Washington on the 20, which begins on the 21st. Because in that time, hopefully we can get a better understanding of where deposit flight is headed with respect to the regional banks, what kind of stresses those balance sheets have come under as a result of the rate hikes, and what it means for the broader financial system. If the Fed gets clarity on that, they can use the CPI reading in a more neutralized way. If they don't, then that policy decision is going to be extremely difficult.
We've also got retail sales coming up later in the week. Any expectations there?
It's going to be a pullback, no question about it. The February number isn't going to mimic the January blowout that we saw. I think we're looking for a decline of about 0.1% on a nominal basis. The inflation picture is slowing, just not at the acceleration that the Fed would like it to see. So that is opening up a little bit more of the discretionary spending box. But nonetheless, gas prices still remain relatively elevated, and that's going to eat into the ability to spend. And food price inflation, too, is at very uncomfortable levels. So we'll see where that all plays out. But I think ultimately we're looking at a pullback for the February number.
Martin, I am somehow simultaneously out of questions and also just getting started because I could, as I said before we came on, I could do this as a 3-hour special with you. I have so many questions, but I kind of want to give you the opportunity here to address anyone who's watching who's saying, help me make sense of all this. What does this mean for me? How concerned should I be? Give us the Martin 30,000-foot view of the story that we're talking about and what it means in terms of the broader context for all of us.
Yeah, I honestly, JD, I think it's going to remain uncertain for a number of days now, simply because bank runs don't have any particular logic behind them. Sometimes people, and rightfully so, just don't feel comfortable with the institution in which their money is placed, and they'll pull it out, even if the reasons for doing so aren't necessarily sound. You simply can't arrest that. All you can do is try to engender confidence in the broader financial system. And to that degree, I really do believe that that Fed backstop is going to prove pivotal in all this. I think it's being underplayed in the media at the moment, but I think it's going to be an absolutely central plank in getting to the bottom of this, because banks around the country are going to be able to access this window without a discount to the price of their treasury holdings and get very generous loans in return. That should be more than enough to cover concerns about the depositor base. Meanwhile, the FDIC has essentially said that deposits are going to be guaranteed without taxpayer support. If both of those things can turn out to be true, Some of these bank stocks are going to look incredibly attractive going forward, but I don't recommend going in just now. In fact, I don't recommend assuming there's going to be any end to this chaos for a number of days until we understand where the bodies are buried and where the dust is settled with regards to deposit flight. So we'll have to watch Treasury bond yields, we'll have to see that CPI reading tomorrow, and ultimately we'll have to see how the bank stress situation plays out over the coming days. It may take a while to get through the thicket, but ultimately I do believe what the Treasury did in terms of deposit guarantee and what the Fed is doing with respect to its lending backstop are going to prove critical.
That's why you're the man in the know. That's why we do this show with you here, Martin, to calm us all down off the ledge that we may be a little bit too nervous about, where the bodies are buried and how the dust settles. I like that phrase a lot. That is the great, and I do underscore the word great, Martin Baccardax. Martin, thank you for helping us get smarter together, the context and perspective we all need, especially to kick off a week that will be after a weekend that was, especially for many people tuning back in here on Monday morning for the first time. Thank you as always, Martin.
Thanks, JD.
All right, folks, that is going to do it for a busy edition, as you saw there, of The Street Today. Stick with TheStreet.com for more on these and all of the major market stories that matter to you, and we will see you tomorrow.